Hi students. So this lecture for BBA second sem on corporate accounting first. So we are discussing related to the valuation of the goodwill, and in the last class we discussed the problem on the simple average method. So how to calculate the value of goodwill with the adjustments. Okay. So now in this class we will see the capitalization of average profit method. Okay, so this is also one of the important method for the valuation of the goodwill. Okay, so under this method the future maintainable profits of the business are capitalized by applying the normal rate of return. So in this capitalization of average profit method, there are approaches, means there are two approaches to ascertain the value of goodwill. So first one, net asset approach, and second one is what's the actual capital employed. Okay, so it is the actual capital employed is nothing but the liability approach. Sorry. So now see the first one, which is the net assets approaches. So under this net asset approaches, how to calculate the value of goodwill. Okay, so how to calculate the value of the goodwill. So first one, see the what's the formula for the goodwill. So goodwill is equal to capitalized value of business. Okay, CVB. CVB means what's the capitalized value of business minus NTA. So NTA means what's the net tangible assets. Okay, net tangible assets. Suppose if you want to calculate the goodwill, you should know the CVB. So CVB means what's the capitalized value of business. So for that purpose, what's the formula? The formula is what's FMP divided by NRR into 100. Okay, so FMP means what? It stands for what's the, so future, it's a FMP. Okay, so future maintainable profits. Okay, future maintainable profits divided by normal rate of return into 100. So we will get CVB. So as you know how to calculate the net tangible assets, so net tangible assets is equal to what's the total assets minus the outside liabilities, you will get the NTA. Okay, so next one more is approach, which is the actual capital employed. So actual capital employed is what's under this also. So there are some steps are there for the calculation of the goodwill. So see here, goodwill is equal to what's the NCE. Okay, so the NCE stands for what's the normal capital employed. What's the normal capital employed divided by what? Sorry, normal capital employed minus ACE. Okay, so actual capital employed. Okay, so ACE stands for the actual capital employed. So now for this calculation of this goodwill purpose, we should know NCE. Okay, so NCE for this calculation, what's the formula? Future maintainable profit divided by normal rate of return into 100. Okay, and how to calculate the actual capital employed? So this actual capital employed is calculated by this, like this: paid up capital plus surplus plus reserve and minus the goodwill at cost. Okay, so whatever the goodwill at cost is there, no, so this we have to minus, you will get the actual capital employed, and then you have to put into the formula of the goodwill. Okay, so these are the formulas for the both the approaches, which are those net assets approach and the capital employed approach. Okay, actual capital employed approach. Okay, so these are the two approaches. Now we will see the problem on this. Okay, so see here, from the following particulars compute the value of goodwill of Vijay Company Limited. Okay, so following the data is given. So future maintainable profit rupees 15,000, and normal rate of return on capital invested at 15%, and the value of net tangible assets is was 65,000. Okay, so with the help of this information we have to calculate the value of goodwill under the net assets approach. Okay, so here is not given any capital employed, it means what's the paid up capital or the reserve and surplus, that it means what, so we have to use the net assets approach. Okay, so if it is given the share capital, reserve or the surplus, then you have to assume what it is related to the capital employed approach. Okay, so but here is not information like this, so you have to calculate the net assets approach. Okay, so now see, with the help of this information, so we will calculate the net assets approach. So for this calculation of the net assets approach, what is the formula for the goodwill? So what's the formula is what's the capital value of business minus net tangible assets. So the capital value of business we should know, so that's why we have to calculate first the capital value of business is equal to future maintainable profit divided by normal rate of return into 100. Okay, so now see this, capital as value of business is equal to future maintainable profit is 15,000 divided by normal rate of return, it's a 15% into 100, you will get the CVB is rupees 1 lakh. Okay, so now this CVBP is you have to put into the goodwill formula. Okay, and what's the goodwill formula? Capital value of business minus net tangible assets. Okay, so 1 lakh is a CVB minus NTA means what, the net tangible asset is a 65,000. Okay, so the remaining amount is the rupees 35,000, it's what's the goodwill value. Okay, so it will come for the 2 marks. Okay, but you should know the formula. Okay, you should know the formula. Okay, so now see the one more problem on this problem. From the following information, compute the value of goodwill of Sai Company Limited. Okay, future maintainable profit is rupees 24,000, normal rate of return on investment it's the 12%, and the actual capital employed in a business rupees 1 lakh 60,000. Okay, so this is the problem number 2, and it's related to the actual capital employed. Okay, so now you know what's the formula for the actual capital employed or how to calculate the goodwill. So normal capital employed minus the actual capital employed. Okay, so first of all we should know the normal capital employed, and how to calculate the normal capital employed, the future maintainable profit divided by normal rate of return into 100. Okay, and so the future maintainable profit is the 24,000, normal rate is the 12% into 100, you will get the rupees 2 lakh. Now put into the formula, normal capital employed is rupees 2 lakh minus minus ACE, and ACE is given in the problem only rupees 1 lakh 60,000. Okay, so the remaining amount is what, the rupees 40,000. so this is nothing but the value of goodwill. Okay, so like this you have to calculate the value of goodwill under the actual capital employed. Okay, so I hope you understand. So like this you have to solve the problem. Okay, thank you.